Live. I am Matt Skinner, your host and the Dealmaker. Today we got a great show for you today. We got some really cool topics to explore, one of which is all about one of the largest private equity firms and what they're doing in the multifamily space. We're going to explore what they've been doing over the last 5, 6, 10 years, and we're also going to talk about what kind of changes they're making in their strategy right now in multifamily. I think you'll get a lot out of this. We're going to also talk about the Dealmaker Fulcrum, and if you haven't heard of the Dealmaker Fulcrum, I want you to get this book right now, Dealmaker Manifesto. It's at dealmakerbook.com, and in it you'll read about the Dealmaker Fulcrum. The Dealmaker Fulcrum is super powerful, and we're going to talk about exactly what that is in our segment called Tradecraft at the end of this show. Inside of Tradecraft, where we bring you real estate training, real estate information, tips, tricks, techniques that are going to help you make more deals and get paid. We do every single week on this Dealmaker Live. So we'll get to the Dealmaker Fulcrum, and I'll share with you what that is in just a little bit. Right now, I want to point out that Tesla reported its first profit today. Wall Street Journal just posted an article about that, and congratulations to Elon Musk. I'm a huge fan. I'm a huge fan of Tesla. For full disclosure, I do not drive a Tesla, but I love the vision, I love the drive of this entrepreneur, and I love his story. Maybe we'll get into that in another episode, but that guy is just an incredible entrepreneur and has made a very large dent in our universe, which is super cool. So congratulations to that, Elon, and many, many more successes. So I pulled out this article, and the title of it is Breakup of a $1 billion rental portfolio, multifamily, shows investors change in appetite. This is a Los Angeles property called Sophia. It sold for $273 million just the last couple of weeks. It's a 606 unit apartment complex. It's actually only the second highest grossing sale in multifamily in the LA market this year, so plenty more to go around. But what I thought was interesting about this is not the size of this one property or anything like that, but as I read this article, this Sophia property has been owned by the Carlyle Group. They're a pretty famous private equity group. They mostly invest in technology, they invest in aerospace, they do a lot of different multifaceted investments. But what's interesting to find about that is over the last 5 years, they've gobbled up over $5.5 billion in multifamily real estate. And what I found really fascinating about this particular article is what they're doing next. So we're going to talk about that in just a second. This large 606 unit complex, the Sophia apartment complex, was part of a very large portfolio that the Carlyle Group managed and owned and operated. And at first they took this whole $1 billion portfolio to market as a bulk sale. And part of what this article is about is why they chose to break up the portfolio and start selling these off in pieces. Now, I think the common sense idea, or maybe commonly known, is you usually will get more money for individual pieces. It's kind of like if you bought a case of water and brought them to, I don't know, like a sporting event or something when people are walking by, it's super hot out, you could sell those smaller units for more money than you would be able to sell the whole case. It's the same concept in just about anything. Bulk usually will mean a better price or a better discount. Just think of Costco or something along those lines. But here's the thing, in multifamily real estate, specifically in commercial real estate, what we oftentimes find is buyers love portfolios, whether it's another equity fund, a hedge fund, or even like a REIT coming in and buying a whole portfolio. And the reason for that, why that makes a lot of sense for them, is that they can come in with one fell swoop, one transaction, and be a huge player in a certain market and can kind of control and dominate a market. As you can imagine, if you control the rents on a large majority of units in one specific city, you're going to have a lot of influence, not only politically in that city, but just from a market standpoint. The unseen hand of the market will allow you to manipulate prices in a completely fair and honest way, but just in a capitalistic way where, you know, you want to see rents increase, you start raising the rents, start delivering a better product, bringing it to market. And so large investors love to buy bulk properties for the simplicity, the one transaction kind of simplicity in being able to come into a market and be a dominant force with one fell swoop. So that's kind of one of the strategies of a larger investment group, able to do that. We like buying larger units, like we always say. The more units you have, the more streams of income you have, because with each family that rents one of your units, they're going to work every single day to pay what? They pay first, typically, their housing expenses. My experience shows that most people pay their cable bill first and then their rent, but rent's usually one of the top first priorities for any working family that is living in an apartment complex or an apartment building. So really cool way to invest your money, investing in apartment complexes. We'll show you how to do that with us, with our equity group, in just a few minutes. But suffice it to say, let's talk about what Carlyle Group is up to. So they've acquired, just in the last 5 years, I don't know how many more assets they've had before the 5 years, or how many more apartment complexes or commercial real estate that they've had, but this article says that they gobbled up $5.6 billion in multifamily real estate over the last 5 years. That's a very aggressive acquisition portfolio, no matter how you slice that. Pretty aggressive. So they're very hot on multifamily. We're seeing from this article they're selling at least 1/5 of that right now. So that's interesting to look at. And then secondly, we want to look at this and go, okay, in this article it touches on this very briefly. I'm going to actually research this a little bit more, but it says the Carlyle Group in recent times has been focusing, they've kind of pivoted their strategy into office and industrial real estate, primarily in Atlanta and Pennsylvania. Interesting. I know Atlanta's a big booming city. I'm curious to know what the draw is to Pennsylvania more specifically, but it's an interesting article nonetheless. So large private equity group, super aggressive, super hungry, super dominant in the multifamily space for the last 5 years, kind of starting to sell off some of their portfolio and kind of pivoting to some other types of income commercial real estate. One of the things I'll share with you, kind of the first public broadcast about this, is our group, Thrive Capital, our private equity group, is beginning to make some moves in the hotel business. We've been in multifamily for 10 years. The last 10 years have been the hottest 10 years in multifamily for, in basically all of history. Huge boom in multifamily. We're very fortunate and very blessed to get into the Texas market back in 2009. You've probably heard me tell the story before. Rick Perry, governor of Texas, was out there. Whole economy's collapsing everywhere in the country, and Rick Perry gets on TV and he says, hey guys, he runs these ads in California, he runs these ads in New York, and he says, at that time, 2009, hey man, the sky's falling everywhere. If you're a small business, if you're a big business, if you're any kind of business, and you don't feel like you're being treated well, meaning too much regulation, too much tax, come on over here to Texas, we're gonna take good care of you. And many businesses did. Toyota, Chase Bank, a lot of banks relocated a lot of their stuff to Texas. I can go on and on and on about all the businesses that followed suit with that. Not to mention all the small businesses, small operators that moved to Texas as well during that period. So we went into that market. We were looking for signs of one of the first markets to boom out of that 2008, 2009 bust. Texas was definitely the first one to not only recover, but begin to really thrive after that recession. And buying multifamily out in front of that trend was just a great move. A couple of years later, fast forward, we went to Arizona around 2014, Phoenix 2015, started buying assets there, and same kind of thing. We had State Farm Insurance move their headquarters there. ASU's done a ton of development, really trying to increase their presence in the community around them. And we started looking at these things. Apple came in and built some big facilities. Intuit came in and built some big facilities. There's just a lot of tech going on in Phoenix, Arizona, which is pretty cool. We kind of think about it in California as kind of the backyard of Silicon Valley or Silicon Beach, where after these startups come to California and they get their first round funding, they're starting to look for lower cost opportunities, lower cost places to run their operations from. And for a lot of those folks, moving out of California and into Phoenix has been a really great move for those tech companies. And so we went in, saw that trend beginning to evolve, and we went in and bought a lot of multifamily units, renovated them, made them nice, and made them very millennial friendly. We put LED lights in the pools, made the cool places to hang out, and really made it attractive for those young folks that were moving to Arizona. Some of them quite reluctantly, we found out, but moving to Arizona nonetheless for a big job opportunity with some of these larger tech companies. So getting out and identifying trends in front of the marketplace is the most important thing you can do in the real estate business. Discovering where growth is going to take place, where the path of progress is taking place, and being able to, you don't even really need to be out in front of it, just get with it during the times, but being out in front of it, getting there before Apple gets there, getting there before Google gets there, getting there before Amazon gets there, or whatever companies coming to the market to create a ton of jobs is how you're going to do very, very well in the income producing real estate market. So keep your eye on that. Look around your markets. It doesn't have to be huge. It doesn't have to be the biggest city. It doesn't have to be the biggest company. But just look at population trends. Are people moving to the city you're thinking about investing in, or are they moving out of the city that you're thinking about investing in? One of the markets that we've been involved with and have been watching very closely is in Illinois, and I think that could be a huge opportunity for multifamily and commercial real estate in Illinois, but they keep raising their taxes. And so when they keep raising their taxes, businesses start to move. And when they keep raising their taxes, investors start to move. And when they keep raising their taxes and businesses are moving, and investors are moving, and real estate's doing these things, there's a huge trend from Chicago specifically of people migrating out of Illinois and into Minnesota and Indiana to kind of escape that tax burden. They can buy less expensive real estate, operate their businesses with less regulation, pay less taxes, and so people are doing that, and still have an hour and a half drive to a big city like Chicago. So watch those trends. We like to watch the big players in the market like the Carlyle Group and see what they're doing. Pay attention to what's going on, and let me conclude this with just letting you know that I will probably never stop buying multifamily. We love the income, we love the stability, the safety, the security, and all the things that come with multifamily. We love the multiple streams of income that come from that, tax benefits, cash flow, growth, tons of benefits in it. And we're also looking at now maneuvering into the hotel space, and we'll probably have some really cool investment announcements coming up very soon about that. So with that, let me give you a little more information about how to invest with our group, and we'll see you on the other side. Hey, Matt Skinner here. Everyone asks me, how are you able to consistently beat the market investing in apartments? And I answer, it's all about my secret sauce. My secret sauce has 3 ingredients. The third ingredient to my secret sauce is that I only buy properties that I can add value to. As a general building contractor and real estate developer, I love buying buildings that need some tender loving care, or sometimes a complete renovation that will add hundreds of thousands of dollars in value. I buy the building, fix it up, increase the rents, and either sell for a huge profit or refinance pulling cash out to buy more buildings. To learn the other 2 ingredients to my secret sauce, check out mattskinnerinvestments.com. That's mattskinnerinvestments.com. And while you're there, watch a video tour of one of my latest apartment buildings being renovated. And don't forget to download a prospectus about investing alongside me in my next killer deal. Go to mattskinnerinvestments.com. That's mattskinnerinvestments.com. Welcome back to Dealmaker Live. We've got a couple of callers who've called in, left a voicemail on our voicemail here, and we're going to take those voicemails right now, answer some questions about business, real estate, marketing, sales, business systems, negotiation, or financial intelligence. Those are the topics that we cover, pretty broad terms, but hey, if you're interested in getting some of your questions answered about your business, your real estate career, or some investments that you're making, gosh, last week we even talked about private equity. We talked about angel investing, some startups, seed round capital, and all kinds of cool stuff. So if you missed that episode, make sure you check it out on YouTube. It's there. We broadcast these live, but they're all stored on our channel at Matt Skinner Investments on YouTube, and you'll find it there. So Lane, what's the first roll we got here?
Hey Matt, this is Angel from Florida again. I had another question for you. And this is with cryptocurrency versus real estate. With some of the money that I have left over, I'd like to invest it into something more high yielding, but I'm not sure which market will perform better over the next 10 to 15 years. If the money that I have should be invested into real estate or if cryptocurrency is going to outperform.
Great question, Angel. And I actually get asked this a lot. We're going to talk a little bit about the different types of investing. Angel's question was, he inherited some money. We took one of his questions last week. This was a second call actually, and he said, hey Matt, I inherited some money, a couple $100,000. He wants to invest it for his future, and he's asking about the difference between crypto and real estate, but in a very specific context. He's asking not which one should I trade, flip, or make money in the next 12 months. He's looking at long term. In fact, I think he said 10 to 15 year horizon with this investment. And that makes this question very, very easy for me. And now, don't get me wrong, I'm a real estate guy through and through, so my answer is going to be real estate. But let me tell you why, and let's break down cryptocurrency just a little bit. Number one, you can't go wrong. If you're looking for a long-term investment, real estate is your play, right? The reality is real estate tends to go up in value over time very consistently since the inception of really the discovery of this continent, let alone the United States. So in the United States, we constantly have our population growing from the day we were founded until present day. Our population continues to grow. What does that mean? More people means more demand for the limited supply of what? Land. And with the exception of Hawaii blowing off volcanoes from time to time, they ain't making any more land. So if our supply, our population continues to grow, and the demand, population growth, is outpacing the supply, and supply is actually pretty stagnant as we begin to build and develop and things like that, it can't quite catch up with the increase in demand from the people in this country. And so more people equals better values. It's why we look for cities to invest in that have population growth, usually driven by some kind of business opportunity. So real estate for the long term, very smart, hard to go wrong. If you buy real estate and wait long enough, you're almost guaranteed, and we're almost never allowed to say the G word when we're in private equity or investment space, but I'm going to say it right now. If you buy real estate and wait long enough, you're guaranteed to have a very nice return over enough time. So the way people get in trouble in real estate is by bad debt, bad financing, bad management, bad life circumstances. It's usually not the commercial real estate that hurts people. It's usually bad decision making on how to manage and operate that real estate. So I would definitely say get plugged into multifamily. If you want to buy an apartment complex or be a fractional owner in a nice, well-run, well-managed apartment complex, check us out at mattskinnerinvestments.com. It'll show you how to get plugged in into one of our funds so that you can be a partial owner in a nice apartment portfolio. The other side of it is we also have a program called Simple Growth, and we have a website called simplegrowthbond.com, and we've got a really cool program. You can invest for as little time as 6 months. You can make between 8 and 12% on your money. It's just a guaranteed interest rate, and it's a really cool, great way to get started investing even smaller amounts of capital. Our equity deals typically have a $50,000 or more minimum investment, but Simple Growth is a little bit lower than that. So if you're looking to invest a smaller balance or just want to give our firm a test drive, be happy to show you what that looks like and get you plugged into that. Now, let's talk about crypto. Crypto is an interesting topic for me specifically because I find it fascinating. Number one, let me just tell you that I think I would love to see cryptocurrency be the medium of exchange for the world. I think there's a lot of benefits, a lot of positives. Number one positive is it doesn't have to be controlled by any one central bank or one country. Now, these could be fighting words for some folks, but let me tell you, the central banks are not our friends and not friends to countries that don't fall in line for what the central bankers want to happen. I won't get too deep into that, but I will say, I don't believe crypto is the currency of the future for that precise reason. I believe Central banks and countries will utilize military power to stop cryptocurrency from becoming the currency of the day. So I think that that is the biggest risk in cryptocurrency. So for a long-term play, maybe not a good idea. For a short-term play, you want to day trade it, it's just like, it would be just like going and spinning the wheel on a roulette table. Get out there, make some moves, play with some money that you can afford to lose. I think crypto has a lot of positives, and I think that I would like to see more people supporting that idea. My concern is just the simple fact that I don't think central banks are going to let that go, at least not without their immediate control over the whole thing. So keep an eye on crypto. I think it's got some political ramifications that could make it not such a great long-term investment, especially if you're playing with a couple $100,000 and don't really have a lot of funds to lose. So be careful with that. Let's get the next question out here, Lane.
Hi, Matt. My name is Gage. I'm 27 from Texas. My wife and I are celebrating our 1-year anniversary. We just found out we're having a kid. I want to start saving towards the kid's future and college funds and whatnot. I just want some advice on how to start to do that. I have some friends who are buying properties for to flip and to rent. I've heard good things about bonds. Or should I just start by paying off all my debt and starting fresh?
To rephrase or restate that, 27 years old, just about to have his first kid. He wants to save for that kid's future. I think that's awesome and commendable. And his question was, how do I start? He says, some of my friends are flipping houses. Some of them are holding rental units. Some of them are investing in long-term bonds. And then he also mentions, just with a little comment at the end about, or should I pay off my debt? So this is one of those questions where it's really important to talk one-on-one with somebody about their specific situation. But I'm going to just have a general conversation about some of these topics, and then where you fit in, you'll have to make a decision on what you want to do next. But suffice it to say this: number one, you're having kids. Congratulations. It's one of the most amazing things you can ever do in life. Definitely the most rewarding thing is to raise another human being and teach them how to be self-sufficient members of society. Very, very rewarding, very awesome. Nothing can compare to that. And you get the added bonus of learning unconditional love, which I don't know that you can get unless you have a child. So congratulations to that. Number two, I don't think you have any obligation to save for your child. Now, let me clarify that. I think you do have an obligation to be the best steward of your resources and your assets and take care of your kingdom. You are the king of your household. You need to take care of your queen. You need to take care of your realm. You need to take care of your descendants, your children, and you need to take care of your business and your circle of influence. And if you start doing that by taking money that you've already accumulated and putting it in other people's names, aka your kids, that could be a challenge. I want you to have full control of your assets. I want you to have full control, be the steward of your assets. And so you need to be the decision maker, so that you can direct everything, control the assets for your kingdom, and make sure that you are a good provider for your kids and not just a benevolent giver of gifts to your kids, because I don't think that's going to do any good for them. I really don't. I would much rather see you invest in yourself, get mentorships, get trainings, learn how to be the best human you can be. Invest in that, be a great investor, get involved in real estate, get involved in some of these other things that you're talking about, flipping houses, rental houses, investing in bonds, and being an investor, getting out of debt, because that's the greatest gift you can give your kids. There's one thing that nobody can take away, is when you're a teacher and you bestow knowledge and wisdom on another human, no one can take that away from them or you. And so my advice would be to do that. Now, as we want to talk investments, commercial real estate, very, very good play, especially for long-term. Multifamily, even better. Investment, it's safe, it's secure, it's stable. It's an easy way to get cash flow, tax benefits, and growth. It's a great, great investment product. We also have bonds. that our private equity group has available for investors like yourself. You can invest as little $10,000 and earn 12% interest on it. It's powerful. It's at simplegrowthbond.com. I'll give you a little more information about that in just a few minutes. And to conclude all of this, here's what I wanted to say. If you're in debt, pay off your debt first. That's it. You have bad debt, get rid of your debt, right? If you have bad debt and you're paying 5, 6, 8, 10, 12, maybe some credit cards have 19% interest rates, student loans, all those kinds of things, get that monkey off your back first, and then take the money that you have to play with and begin to invest it. So build a safety net. If you're not already there, put some cash aside for a rainy day. That's number one. Number two, get rid of the debt. Number three, invest in yourself. And number four, invest for your future, which would be real estate. Flip, if you want to get into flips, that's super risky if you're not adept at running construction projects, if you're not already experienced at buying and selling houses on a quick transaction basis. That's a lot of work. It's a big whole other career to get into. And I would just caution you, if you're not good at all of those tasks already, that's a pretty hefty career move to begin to flip houses and things like that. So get into something a lot easier, get into multifamily, get your income coming in, get your tax benefits coming in immediately, see some growth in the short term and the long term. You're gonna be in a much, much better spot than that. So with that, invest in yourself, invest for your future, make sure that you are the king of your castle and that you're providing, presiding, and taking care and protecting your kingdom and your people by being a good steward, by being a good example, and being able to teach the people that you're responsible for within your realm everything that you've learned and all the experiences that you've had. With that, let's take a look at, take a quick break, and we'll be back in just a second with, we got one more call? All right, even better, let's do it, man.
Hi, Matt. My name is Humberto, and I'm calling from the Antelope Valley. My question for you today is this question. I have a house that's probably about worth $350,000. I also bought the lot next door. Okay, I'm recently thinking about selling everything, and I was wondering if it'd be better for me to sell the lot next door, or to try to sell it as a bundle, house and the lot next door. What do you think I should do? Thank you.
Umberto, I appreciate you asking the question. That's a really good question, actually. The question is, you have a house worth about $300K, and you bought a vacant lot next door. Congratulations, that's awesome. You're thinking about selling all of it, and I think the question that you asked was, should I sell them as one package, or should I sell them together? Couple things I'm gonna say about this. I don't know what your real estate experience is. If you've been an investor for a long time, if you've bought, sold properties, I don't know if you got any experience with lots. And so I'm gonna just assume that, like most people watching this, probably have not bought and sold a lot of land. And so I'm gonna kind of take it from that perspective, which I think will help the majority of us involved in this question. Here's the thing. Land with no entitlements or no zone change is just what? Dirt. And what is the famous saying about dirt? Dirt should be dirt cheap, right? So you're not gonna get a lot of value by buying just dirt that has no permits, no entitlements, no zoning changes, and no extra benefits inside of that. Now, I don't know the configuration of your house and where that lot is associated with it, but most people that have a house and a lot usually subdivide the two and will spin off and sell the lot and the house separately, because it's really gonna be two different types of buyers. Unless that lot is significant to the house, where you could expand the backyard or make it part of and grow the size of the property that the house is on. And so if that's the case, and that lot is contiguous and an advantage for the house, which might increase the value of the home, you might want to look at what the value would be if that was the case. But for all intents and purposes, I would suggest you get the best local real estate agent in the market, the guy who's bought and sold or listed and sold the most houses and lots in your marketplace, and have a conversation with him. In fact, I'm going to suggest get the top 3, interview all of them, and ask them what the values are going to be. Ask them to provide evidence of what they would list it for if they took it to market individually as a house and a lot, and if they took it to market as a combined package. Now, let me give you some secret sauce toss on top of this. Here's the deal. You got a house. The best way to get the highest value from that house is to bring it to its highest and best use. So if you have the means, you got a little capital to play with, I would suggest moving out and fixing up the house, selling it at full retail value. You're gonna get the most amount of money for the house when it's in its very best pristine condition. So think about that. Next, if you want to maximize the value of the lot, I'm going to suggest that you go down to the city and have a conversation with the city engineers, and also probably want to hire your own civil engineer to research what is the highest and best use for that land. Now, I'm not even suggesting you got to develop it. I'm not suggesting you got to build a house. I'm not suggesting you build storage. I'm not suggesting you build a motocross dirt track in the back. Whatever it is, I don't know what the highest and best use is. But there's a million things you could think of to use that land for, to use any land for, right? But the reality is, what is going to be the highest and best use to create the most value from that land? And it might just be getting a simple zone change, which might cost a few $1,000s, a couple of hearings at the city, and moving forward, getting something like that done really quickly. So for an example, if it was zoned single family, but a large enough lot to build, 10 units, 12 units, something like that, but you'd have to go to the city and get the zoning changed. If you can do that for relatively inexpensively, that might be your best value play. Vice versa, if you've got land that's zoned agriculture and you can rezone it into housing, so somebody could build a house there, that adds value to the land, right? That adds value to the land. So subdivisions, zone changes, pre-planning for highest and best use, and you don't have to build a thing. A lot of people are in business of just buying lots, re-entitling them, getting new zoning, getting permits pulled, maybe even designing buildings, but with no intention of building or constructing anything. And you can just sell it to a builder who wants something that's already pre-approved or ready to go. So those are the ways you can maximize the value of your lot and your house and get the best return on your investment for both of those. So best of luck to you, Umberto. I appreciate the call. And this is Dealmaker Live. We'll catch you on the other side of the break. Welcome back to Dealmaker Live. I am Matt Skinner, your host and the Dealmaker. This segment, we're going to talk about tradecraft. I stole this terminology from the CIA. I'm a huge fan of Navy SEALs and CIA clandestine operations. I read a lot of Tom Clancy books. And what did I get out of all that? I got one cool phrase, and we call it tradecraft. Tradecraft is literally what you do to implement your trade, the craft that you implement in your trade. Our trade here is investing. And so this segment is all about teaching you some of the tips, tricks, and techniques that I utilize in my business to make the best deals and get paid. In just a second, I'm gonna pull up my whiteboard. I'm gonna talk to you about what the Dealmaker Fulcrum is. And if you haven't heard about this, like I said, we talk about this in my book, The Dealmaker Manifesto. Get it at thedealmakerbook.com, not The Dealmaker, it's just dealmakerbook.com. Get your book. I think we have a free plus shipping. You pay for shipping, we'll send you a free copy. Jump in there, grab the book, and you'll get more details on the Dealmaker Fulcrum. In fact, one of the things I want to say about this book is I didn't write it as a real estate training book. My background and my stories happen to be about raising money, doing deals, development, multifamily, and so I tell a lot of stories inside of that about being an entrepreneur, being a businessman. But this book is called The Dealmaker Manifesto, and it's the real estate investor's guide to making deals and getting paid. And what this book is really about, it was inspired because I have a whole bunch of people come to me and they say, Matt, I invested tens of thousands of dollars in coaching and mentoring and real estate training, and I haven't made my first deal, and I really don't even know what the heck I'm doing or what the next steps are. Can you help me? And the first thing I want to have a conversation about regarding that is you need to have more than just the technical training on how to do deals in order to be a deal maker. You see, success in life is all about who you are, who you're being, and who you and if you want to have and do all the things you want to do, have and do in life, you need to be somebody different. So if you're not getting and not experiencing and don't have the people around you that you hope to have around you, you need to change who you're being. And so this book is all about who you need to be in order to do and have all the things you want in life. And that is what this Dealmaker Manifesto is. We call that person who does what he needs to do to have all the things that he wants. We call that person a deal maker, right? We call that person a deal maker because a deal maker knows how to put deals together, knows how to communicate well, and has a significant amount of influence in his circles. And so this book is really about who you need to be in order to do and have all the things that you want in life, including we train on how to market yourself, how to sell, how to negotiate, how to implement business systems so that things can happen over and over again after you figure out how to do it right the first time. And it also talks about financial intelligence and how to gain that wisdom for yourself. Powerful book, not just about real estate. I think this is great for anybody who wants to have success in life. So make sure you get it at dealmakerbook.com. And so for today, we're going to talk about one segment that's in this book. And that segment is called the Dealmaker Fulcrum. And the Dealmaker Fulcrum is just this. For those of you guys that are not engineers, fulcrum is a center point where we have a lever, right? And we might want to envision this as like a teeter-totter. And in the middle of that teeter-totter is a fulcrum, which is a balancing piece. And so if you got this fulcrum that's out like this, right? We have in this, the Dealmaker Fulcrum, how it relates to real estate is on one side of this teeter-totter, we've got price. And on the other side of this teeter-totter, we got terms. And so price and terms sit on this lever that rests on the Dealmaker Fulcrum. So what does all this mean? Now we got clandestine operations, we've got CIA terminology, I just gave you some engineering terms, all this stuff. What does this really come down to? I'm going to grab my whiteboard and I'm going to show you what I mean by this inside of the Dealmaker Fulcrum. And the first thing I want to say is when we're looking at any deal, we have two ways to make a great deal. Most people who are investors, and most people, especially when they're starting out as investors, they're going to almost primarily, almost exclusively be focusing on price. So if they go out and look at an asset that's worth $6 million, their only tool in their toolbox to buy that $6 million property at a good price is to just lowball their offer, give them a low price, right? And why would somebody be motivated to take a low price? Well, usually that motivation, if any, is going to derive from the terms that are coming with that low price. They don't have to worry about the buyer qualifying for a loan. They can close on a certain day. Usually an all-cash offer is going to include a non-refundable cash deposit that the seller can take if they don't perform. And so in this case, if somebody's coming in to buy an asset with a low price, the seller is going to want to sell that property on their own terms. Quick close, all cash, close quickly. Those are advantageous terms for the seller. Low price, advantageous for the buyer. Now, what if we took this fulcrum and let's ask ourselves, a real estate agent's objective is to get this lever as balanced as possible. We have price on this side, we have terms on this side. A real estate agent's job, their purpose is to make the transaction go as smoothly as possible with the least amount of work specifically for them so that they can make more money with less effort. I'm not saying anything bad about real estate agents. I'm just saying that their interests are not always in alignment with the buyer or the seller necessarily. They're going to be looking out for their best interest all the time. And so they're looking for a nice, equal, even playing ground with this Dealmaker Fulcrum. So what that would typically look like for a real estate agent is a reasonable down payment, right? 25%, and a traditional bank loan. A lender that they know, a lender that has funded other deals for them, and just this creates a nice even-keeled transaction for this asset. But if we're gonna be investors, like we don't wanna be buying stuff retail price. We definitely don't wanna be paying, 25% or more down. One of the advantages we get in real estate is we get to use good leverage. We get to use good bank financing. We get to put less down and leverage our returns. It's very, very powerful. So as a real estate investor, our job is to take this fulcrum and make it as radically out of balance as possible, right? With our price and our terms and our price and our terms. If you can read my writing, then you're amazing. You're probably a doctor, just like me. And so we have our price and our terms sitting here. What does this mean? We want to get this fulcrum radically out of balance. Well, we talked about one way, right? If I come in and I want to get a low price on a property, I'm going to come in and I'm going to offer a low price and very easy, advantageous terms for my seller. What that might look like is asking them, if I paid all cash and closed quickly, what's the least you would take? If you haven't ever heard that question before, write it down. It has made me millions of dollars since I learned it from a mentor of mine 20 years ago. If I paid cash and closed quickly, what's the least you would take? And I've seen hundreds of thousands of dollars fall off a purchase price. One simple question. One simple question. Negotiation, by the way, is the fastest way to make money, the highest paid profession that there ever has been. A good negotiator can make hundreds of thousands, even millions of dollars in an instant by using their words. And so that's what we talk about in Dealmaker Manifesto, and we teach you how to do that and get better at it. But so if I ask the seller, if I paid cash and closed quickly, and he gives me a price, and that price is lower than retail value, my terms are closing quickly, right? My price is I'm asking for a discount. So in this case, in this fulcrum, we've got price on the low side, terms on the high side in this case. Getting back to our whiteboard here, what if we do it the other way? What if they're asking on the same asset, $6 million asset was our example, and what if we were able to pay full retail price or even over their asking price? I do this all the time. We have a whole strategy, a whole training course on creative real estate finance where we talk about making 3 different offers: all cash, making offers where it's more of a traditional opportunity, and then using terms to our advantage, which we call creative real estate finance. And so in this case, if they're asking $6 million and I can make that price pencil, but I can't put 25% down like a bank might have, I might consider having the seller either carry part of the down payment or carry part of not just the down payment, but carry part of the financing, carry all of the financing on this deal. So what that might look like is, what if we said, I'll put 10% down and the seller is going to carry a 90% loan. But if this makes sense from a cash flow standpoint, and we're in an emerging market that is all telltale signs says it's going to go up in value, then what would be wrong with using better leverage like this to get into a deal with good financing? I'll give you a quick example of a deal that I did like that using terms. One of the very first buildings I acquired in Los Angeles had something like a $1.9 million existing loan. The seller was asking $2.7 million for the property. And so I came in, I discovered by asking the seller some questions like, if I paid cash and closed quickly, what's the least you would take? I also asked them if they'd be interested in seller carry, or even giving me an all-inclusive trust deed, AITD, or as some people know it or call it, is subject to, taking over the existing loan or taking over the payments on the existing loan without actually assuming the responsibility for it necessarily, or I should say qualifying for it. You're definitely responsible for it, especially if you promise somebody you're gonna pay it, and you best damn make sure you pay it. But what I mean is going to the bank and getting qualified for that loan. So in this particular case, I took over the 1.9 million existing loan, all-inclusive trust deed. All that means is I just started making the payment the day I took over the asset. Next, I took, I think I gave them $200,000 down, and we had an $8 million spread between 2.7 and 1.9. I was able to pay them their full asking price, even during a recession. This was, 10 years ago. And I put $200K down, and I had the seller carry the balance of the down payment with a very structured accrued interest payment. Anyway, long story short, I was able to buy an asset in Los Angeles that had a day one cash-on-cash return of 13%. We're at the bottom of a market. Prices were low. I knew were going to go back up. And so I was willing to use this good leverage to allow those prices to rise, allow the momentum of the market to create value for me. And I was able to get in with a very low down payment, a very highly leveraged asset in a rapidly growing market, in a strong growth market where rents were going up, and we're able to utilize this kind of structure that I'm showing you here on this whiteboard, where price and terms were radically out of balance. Price and terms radically out of balance. So I want you to catch this, because if you're going to be a deal maker, or if you're going to invest with a deal maker, then you need to understand how great deal making takes place. Great deals are made. They're never going to just fall out of the sky and land in your lap. To make the best deals, you have to create them. And to create them, you've got to understand your market, know the marketplace, and one thing's for sure, to be a deal maker, you must think outside the box. So I want you guys to go seize the day and make deals and get paid. You're doing and pay attention. What I'm about to tell you could save you tens of thousands of dollars and will change the financial future for yourself and for your children for generations to come. Smart investors are beginning to see the writing on the wall. The stock market is at an all-time high, the housing market is at an all-time high, and at the rate things are going, we may soon have a new war coming. This is Matt Skinner, and I just released a book entitled The Ultimate Investment Strategy. And in my new book, I outline a secret plan that smart investors are implementing right now to safeguard their winnings from the casino on Wall Street and to protect their gains that they made in the housing market. Right now is the time to take your chips off the table and put it in a safe, secure, stable investment. The ultimate investment. In just a minute, I'm going to tell you how to get a copy of my new book, The Ultimate Investment Strategy, because in the book, I outline how you can bulletproof your investment portfolio from the bursting bubbles that are sure to happen. I'll show you how to build a fortress around your nest egg, meanwhile producing a truly massive, passive cash flow, tax-free income for life, and outperform the stock market year after year. It sounds too good to be true. I used to think so too before I discovered this well-kept secret that the ultra-wealthy have seemed to know for centuries. Get my book, The Ultimate Investment Strategy, and discover how you can bulletproof your investment portfolio today. The Ultimate Investment Strategy. Do it now. Trust me, you can't afford to wait.